Thank you very much, Louis-Philippe and the other organizers. It's a pleasure to be back in Toronto. I'm just in Hamilton, but I don't have that many opportunities to come to Toronto, and in particular airfield. So this is great. So I apologize, I was not here for the entire workshop, but I was trying to pick up the thread from the discussions and in particular things that have already been said. I think I'm going to repeat some of the themes here. So, you know, bear with me, but maybe I'll present something with a fresh perspective. So I'm going to concentrate on two things, COVID-19 and what central banks did and a comparison with what they did in 2008, and then what I think central banks should be doing for climate change. And along the way, we'll talk a little bit about wage share and wage distribution. So what they're doing in 2019, so this is a picture to show you why central banks sprung to action very quickly in March, 2020 for COVID-19. So they sprang to action because financial markets were showing signs of distress not seen since 2008. So these are two measures of financial volatility. One is the TED spread, is the spread from between interbank loans and treasuries, and then the other is the VIX, the volatility index. And you see there that in 2020 they spiked very much the way that they had spiked in 2008, and then this got everybody in panic, in particularly central banks. Here's a different measure of that. This was what's going on in stock markets. So you see the precipitous drop in both the Dow Jones and the S&P for the week of March, you know, second, third week of March 2020. And in percentage terms, in 1 week or so, it was more than what took months to occur in 2008. So that got central banks really interested in doing something. And so what did they do? The first thing that a central banker do, I divide that in, you know, lines of defense. The first line of defense is cut interest rates. So the ones that could cut, so there's the graph of interest rates prior to the 2008 crisis. Then, you know, there were many cuts because of 2008. Then many central banks remained with rates low. Some central banks gradually started to increase. So the ones that had room to cut, they just said, okay, let's cut to what it was before, 0. We don't care. Let's go down. But that was not enough. So this was not enough to calm the markets. In 2008 was not enough to calm markets in 2020. So the next thing that central banks do is to act as lenders of last resort. So this is a graph of you know, what used to be called the discount window, then the Fed changed it to the primary credit facility. So that was used in 2008, but to remove the stigma of going to the discount window, they created this auction mechanism that was much more used than the discount window itself. But this is still for, you know, the core of this system, the primary banks that have access to those facilities. This was not so used in 2020, but it had a little bit of use. The next thing that they did then was still as a lender of last resort, but using emergency powers. So this is the fable section 13.3 of the Federal Reserve Act, which allows them to lend to more financial institutions, and in fact allows them to lend to anybody. But here is still primarily to financial institutions, just a larger number of them, and with a larger set of collateral. So there's several facilities that were created still on the basis of lending to specific institutions so that they could use the newly available funds to do different things, primarily to go and buy assets in distressed markets. But this is still under lending, but under emergency powers. That was not enough either in 2008, and so it was used 2008, was used 2020. They felt that they needed to do more. I think I have, swap lines. So swap lines is not about the domestic financial market. It was understood both in 2008 and 2020 that in a dollarized global economy, financial distress of international markets has to be backstopped by the Federal Reserve Reserve as well. So the Federal Reserve created swap lines in 2008 with 6 major central banks that were heavily used so that those central banks have direct access to dollars, and then they can lend those dollars to their jurisdiction. In 2020, there was also instant, as soon as they became available, they were fully utilized, and this time to a larger group, by a larger group of central banks, including Turkey, Brazil, and other countries. So they just extended the availability of those swap lines, and they went like crazy, like firecrackers. So but then again, the story continues. So it goes now to what Perry Merlin and others call a dealer of last resort. So this is more than just lending. This is a central bank making markets. So this is when there is no, the markets freeze, there is no natural buyer for things that are in the market. And the central bank goes there and buys directly assets, be it commercial paper or different types of assets. So this is some of the facilities that were created in 2008. So, famously called things like Maiden Lane and things like to buy stuff from Lehman, Merrill, and other distressed financial institutions. So this is just is directly purchasing assets. In 2020, that took a different twist. That went for classes of assets that were inconceivable in 2008. For example, commercial bonds, corporate credit, right? So they went directly and bought corporate credit. So this is not too far removed from lending to corporations directly. They go in a market and buy the credit of those corporations. And then quantitative easing, which it really is the reflection of this dealer of last resort. They post-fact rationalize quantitative easing with traditional arguments. Well, buy things to lower interest rates, blah blah blah. The first spike in quantitative easing had nothing to do with that. That was to make markets. So these were markets that were in distress. They went there and bought things, and then they just continue doing that. Again, rationalizing on traditional arguments, but I'm going to say later that the true reason is different, and I think it touches on something that Matheus either said today or earlier, but people attribute it to Matheus, the financialization of the banking system. And then the difference is that in 2020, that also occurred much faster and in a much larger scope. So just look at the derivative of those graphs there. The amount of purchase, massive scale asset purchases that went on in March 2020, they were buying each week what took month and month to buy in 2008. And they were unapologetic, and in making the pronouncements and explaining this, they would just come out and say, we need to buy this stuff to stabilize markets so that they can continue lending to Main Street. We're doing this so that traditional lending doesn't stop. So follow the argument. You're going to market so that traditional lending doesn't stop. So why is this? And before we get to why is this, there's one more picture. Now the combined effect of all those measures in the balance sheet, so both lender of last resort, dealer of last resort, quantitative easing, and so on. This is what happened during the crisis in 2008. It continued to expand. There was a brief period where they thought, QE would go down, and then 2020 happened, and that was this very spike in expansion, and is continuing. So why, you ask? Again, just to show that this was not peculiar to the Fed. All the other central banks did that. The Bank of Japan did, the Bank of England did, the Bank of Canada had the largest proportional expansion of the balance sheet of all the central banks, Bank of England, so it's all over the place. And the explanations were the same. So, Madame Lagarde came in and said, we're doing this to provide credit to Main Street. So how does that happen? Why do they need to go and buy assets to provide lending to corporations and to households? So this is what I call the illumination of shadow banking. You heard this first here. I think I hold a trademark to that. Is in the paper in Rope. So what happened between 2008 and 2020 is that this normalization of this mechanism. In 2008, they used to call it shadow banking. You don't hear that anymore. They even changed the name. Throughout, the Financial Stability Board was created to monitor shadow banking. The first thing they do is not to call it shadow bank. They call it non-banking financial intermediation. It sounds much better than shadow banking, doesn't it? Non-banking financial intermediation. And by their measure, as an institution base, like an institution that does that, but it doesn't have direct access to the Fed or to central banks, it's about half of all banking. But there's a broader definition of this, which is what Perry Merlin called security markets, lending of money market funding, where on both sides of the traditional model of a bank, you don't have deposits and loans anymore. You have markets on both sides. And if you count by activity and not by institution, then what is here referred to as market-based finance, it dwarfs traditional finance. So that means that this is the way that finance is done. It's all through markets. And because it's all through markets, any sign of instability requires the central bank intervention in all of the markets. So that's what they were doing. And there's a lot under the hood here that I'm not saying, but, along is this really a complex mechanism of repos, and repos have, haircuts and complicated structures for when things need to be triggered, and it's all to do with the stabilizing debt price. And if that's not stable, then the credit markets will freeze, and then there's going to be no lending to Main Street. So the central banks got their mandate to do this. That's what they do under the world where shadow bank has been illuminated, has been brought out from the shadows. So that's the first part of the talk, I think, because now we jump to climate finance. But what is the takeaway from the first part is that central banks are doing things that they never did, and they're being pushed to do things that they never did. They expanded their mandate very much, and now I want to say, if that's the case, here's another crisis for you. It's not COVID, it's not 2008, it's the climate crisis. So you got a new mandate, you got an expanded role to play in society, play the role for the climate crisis as well. Why? Because something's got to be done. So this is a graph of what is the current climate funding, the financial flows to fund R&D and all sorts of other carbon reduction projects. And this is what is estimated that the funding has got to be. So it needs to quintuple to achieve the goals that several climate finance organizations advocate. So how has it been done currently? So this is a breakdown from different years. That's what's been done in 2019 and 20. But that's the amount that needs to be about 5 times larger. There's still like a kind of even proportion of split of public and private. So what are the public investments? They're like direct subsidies and direct investment in emission reduction projects. And the private ones, they go through financial markets. And what we're going to advocate is that to increase the amount of private financial flows, the central bank can do exactly what it did through COVID, which is to go and buy assets in those markets. And the assets that they could buy, well, I'm not going to give away the story at the end. Let's just back up a little bit. So how does now this type of financial flow integrate in a macroeconomic model? So we are the Fields Institute. I'm a mathematician. I like models, but I like the kind of models that you guys do. So I don't like Nordhaus's model. I don't like the dice model. And this is the famous quote from Albert Einstein that God does not play dice with nature. So I'm borrowing the quote and say that God does not play dice with the climate. Because what is the dice model? It's essentially a exponential growth Ramsey model coupled with the climate component, but the climate component cannot do anything to the economy very much. It does a little bit. It shocks the economy from time to time through those damage functions, but it shocks something that it's bound to return to an equilibrium path because the model only has an equilibrium path. If you have a model that only has one equilibrium, it doesn't matter what you do with the model, it will return to the one equilibrium. Theoretically, there's the, what is it called? The transversality condition that needs to satisfy. It just throws away all of the solutions that don't do that. And the implementation of this in the program, in the code, I ran the DICE model, you shock it, you can make it have 80% of damages. The damn thing goes back. Take it a long time, but it goes back. It just doesn't have another equilibrium. So that's why the DICE model looks like this. All of the trajectories of the DICE model are just, indistinguishable from each other's. And they even joke among themselves about this. Like the co-authors of Nordhaus that says, well, you see, you need a really sharp pencil to see the difference between GDP with climate and without climate damages, right? So incorporate that, start to make that sync because the model is like that. So I don't like that at all. I prefer a model like this. So it's called Coping because it came from a paper from AFD and Gaël Giraud and collaborators called Coping with a Collapse. But of course, all the models have acronyms. So I keep pushing Gaël to create an acronym for it. So climate, output, something like that. He hasn't done that yet, but I think he should. So the Coping model. And it's a stock flow consistent model based on things that you have heard, perhaps me talk about before, the Goodwin model, the Keene model, but now couple that with the climate. So now we're talking about something is qualitatively substantially different. It has a multiple equilibrium, so it can collapse. You shock it large enough, it can go to an equilibrium where things go badly. And then policy now becomes avoid that collapsing outcome at all costs. It doesn't mean do a small trade-off so that, your cost and benefit send you back to the equilibrium growth model. No, there's no cost and benefit trade-off. It's like avoid the collapsing state, okay? So this is the schematic for the model. There's an economic core in there, traditionally with production, and then there's some stuff that goes into consumption. But crucially, there's part of production that is dedicated to abatement to reduce emissions that can increase the cost for the firms involved in it, so it can increase the private debt. So now the nonlinear interaction of private debt with the rest of the economy can create instability within the economic part, as opposed to the Ramsey model that doesn't have any instability. But if you do enough abatement, you're going to reduce emissions, and by reducing emissions, you enter this climate part here at a better position. So there's less CO2 accumulation. There's going to be less damages because damages ultimately will affect your production and your GDP. So that's how the logic integrates here. Let's see some runs of this model. So here's from the AFD paper from Bovari, Giraud, Matheus, 2018. And you can see here, so this is just the sort of reduce the projection of the model only in 3 dimensions. There are many more dimensions, but it's tracking 3 variables. Employment, wage share, and debt, which are the key variables in the economic part. So it's doing the asymptotic here when the climate model goes to its equilibrium. Eventually, emissions get reduced to 0 because the model does abatement, might take long, but eventually there's going to be a transition. And the point is, this temperature is going to a stationary temperature, so it has some level of stationary damages. Now plug those damages back to the 3-dimensional model and see what they would do to the economic part. And you can see here already in this graph there, the difference between this and the DICE model. It does present a bifurcation. So this is what's happening to the employment and wages as the asymptotic equilibrium temperature increases. So things get progressively worse, but just, gradually until it gets to a point, and this is precisely around the bifurcation that climate scientists say that will happen around that temperature for climatology reasons, but that bifurcation also happens in the economy. At that point, the system goes to a situation of, collapse in employment, collapse in wage share, and explosive debt. So what do you do with a system like that? If you want to bring it back, you need to avoid that. So you need to avoid the excess burden on debt for firms. And this is where now the policy that we're going to propose here, which is, yes. So I will talk about the policy because the next graph will show a result with the policy. So there are many things that you can do, and I'm going to throw at the end like a type of kitchen sink list of things. But one is green bonds. They have a bad rap, but I want to bring green bonds back. So green bonds are essentially a way for firms to finance green projects at a lower cost. The point is that they are not that cheaper the way that they are being traded now. So there are many papers, both empirical and theoretical, saying if there is a green bond premium, if the green bond should be more expensive than a regular bond, and therefore the interest rate is lower than a regular bond and it's cheaper for firms to finance. So they find that it's a wash, right? There are reasons for being cheaper and there are reasons for being expensive, and it kind of cancels each other. Unless there's a market, there's a player in the market that buys these things massively. So that's massive asset purchase, that's quantitative easing, but it's green quantitative easing. So the central bank can go in and buy as much green bonds as they want to drive the spread between green bonds and traditional bonds as much as they like. And so now what we do in the model is run the model with this spread, the delta B, as a control variable, because this is now what the central bank can control. And what you're seeing here, so that's time, but what you're seeing here is the total finance cost for firms. So the combination of regular loans and green bonds. So the total finance cost, if the spread is low enough, and I'm running this in the sort of unfavorable scenarios. I'm running this in high damages, no other policies. So I'm just showing that green bonds alone have the potential to turn. So this here with no spread, so no green bonds, the total finance costs go much higher than the economy can absorb. So 2.2 total finance is 2.2 times GDP, which is close to what the total amount of capital in the economy is, which is close to the level where there's going to be generalized bankruptcies in the economy. But green bonds eventually can bend this down and then, run the model long enough and this total financing costs go down. So this is just to show in this key variable the effect of the policy. But now the next graph is going to show the effect of the policy on more variables. So this is for the rest of the model. So I'm showing here three things. So there are three lines. The red line is no policy. You don't do anything. You just do business as usual. The blue line is the only thing you do is carbon tax, and a quite high carbon tax. So at the levels that are being advocated by the Stiglitz Commission and so on and so forth. What's the problem with carbon tax? It has some effect on emissions. So it does bring emissions down. So this is with no policy. It takes too long for emissions to come down. That's basically just letting the economy decarbonize by itself. With carbon tax, the emissions go down faster. You can maintain the temperature at a reasonable level. By the way, the intervals, the shaded areas are the confidence intervals here, okay? But the problem is that, and you're going to see in the next graph, if you have high carbon tax and no other alternative for firms to finance this green transition, their debt goes too high. And then there's the economic breakdown, not the climate breakdown, there's the economic breakdown, which then leads to this, deflationary scenarios. And yes, so not so good. Let's look at other variables in the model. So this is for output growth. So eventually in those situations, you are at the collapsing equilibrium of the model, in particular for wage share and employment. And this is the reason, is that the private debt share goes out of control. But with the monetary policy of green bonds added, the first thing that happens is that it stabilizes the private debt. And by stabilizing private debt, it stabilizes everything else in the model. The only variable that remains with a large spread, you see in the previous graph, is government debt. It does have some variability, but the median for government debt remains finite, at least. Of course, because of the uncertainty in the model, you can have runs in which government debt goes out of control, but you know, I mean, you can't have everything in just one model. And I think that's the last thing I wanted to show. Yes, so now we'll go to conclusions, and then we can go back and discuss if you want. But so the COVID crisis led to unprecedented responses from central bank, both in magnitude and in scope. They did stuff that was different from what they did before. The illumination of shadow bank turned this dealer of last resort from something that they would do after all the other measures were exhausted to something that they did on day one of the response for the COVID crisis. The line between fiscal and monetary, so people talk about fiscal dominance before, that debate is lost in this universe because, you know, as what the ECB was doing, the ECB goes and buys government bonds from the euro area, not because the governments are running into trouble. They buy government bonds so that the private credit markets can function, because the government bonds are the collaterals for the repo markets that are behind the market-based operations. So distinction, because fiscal and monetary policy is lost. You have the European Court of Justice rule on that. I mean, that's completely lost. This opened up new possibilities for central banks on green monetary policy. I'm only talking about green quantitative easing, but there are other things. So, for example, green collateral requirements for lending, or green capital ratios for how the banks can structure their capital adequacy ratios that would lead to more green loans. And, you know, there's something to do with the beer with John later. We can devise green, whatever you want, could be a green outright transfers. Okay, so just the point is do it. Potentially has a high impact on the long-term stability of the green transition, as I said, by avoiding this catastrophic outcomes, while at the same time narrowing the confidence interval of the outcomes. Thanks.